A major global conflict often triggers a counterintuitive primal instinct, opening a brokerage app before calling a neighbor or checking the pantry. Financial anxiety redirects our focus toward a portfolio that rarely needs immediate intervention during a crisis. The financial media ecosystem relies on that specific anxiety. When tension spikes, viewership and ad revenue follow. This is why a standard 2% market drop on a Tuesday will be labeled a global freefall across every broadcast monitor. Panic is the product, and alarming language keeps viewers watching until the commercial break for a brokerage platform. Mark and Sarah are two investors who illustrate this divide. In February 2022, right as the invasion of Ukraine dominated the news cycle, they both held identical $40,000 portfolios built on standard index funds. Mark spent 3 straight hours consuming fear-based media coverage. By 9 a.m. on the morning of the invasion, he liquidated his entire portfolio and moved everything into cash. This bar chart reveals the danger of Mark's decision. JP Morgan tracked a $10,000 investment over 20 years. Left alone, it grew to $71,000, but missing just the 10 best trading days dropped the return to $32,000. 7 of the 10 best trading days usually occur within 2 weeks of the 10 worst. Hitting the sell button provides an immediate psychological relief, creating a false sense of control. In reality, it permanently locks the investor out of the inevitable market snapback, leaving them on the sidelines trying to determine when it feels safe enough to buy back in. The media narrative assumes that markets die during armed conflicts. 110 years of historical data proves the opposite. Across a century of global crises, markets reliably climb. The data on this chart shows the upward trajectory during major historical conflicts. During World War II, the Dow gained 50%. During the Korean War, it jumped 60%. The S&P 500 has delivered positive one-year returns after 73% of all armed conflicts since 1945. Wars function as aggressive government stimulus programs. The government instantly becomes the world's largest customer, spending without limit on logistics, fuel, and infrastructure. This capital flows directly into the earnings of publicly traded companies. Moving to cash during a conflict means opting out of a massive economic stimulus event. An investor misses the corporate growth entirely right as wartime inflation begins to aggressively erode their purchasing power. Sarah ignored the news cycle and built a structured 6-step portfolio. Step 1 is the cash floor. She secured 6 to 12 months of living expenses, including $2,000 to $5,000 of physical cash kept at home. Physical cash serves as a specific hedge against cyber warfare disabling digital payment infrastructures. When Russia was cut from SWIFT in 2022, the messaging network banks use for global transactions, citizens encountered non-functional ATMs. Physical cash ensures survival if the digital grid pauses. Sarah stopped there with her cash reserves. Holding excess cash beyond an emergency floor is risky because wartime inflation averages 4.5%. Any surplus cash sitting in a standard savings account loses value as real assets climb.
Step 2 is gold, targeted at 10 to 15% of the portfolio. Many amateur investors buy gold at the height of a crisis, paying a massive fear premium right at the peak and losing money when the worst-case scenario fails to materialize. Sarah's gold allocation is based on structural demand. Starting in 2022, central banks began purchasing over 1,000 tons of gold annually. This represents institutional repositioning as sovereign wealth managers diversify their reserves away from the US dollar. This foundation provides immediate physical security for a grid-down scenario and baseline wealth preservation against inflation. It establishes the base of the portfolio. Step 3 is defense, representing 10 to 15%. This sector is driven by massive government spending and industrial backlogs. These companies hold multi-year contracts for weapons, vehicles, and intelligence systems that must be fulfilled regardless of when a conflict ends. This shift is part of a decade-long structural trend. In 2022, Germany approved a €100 billion special defense fund. European defense stocks have surged 260% since the invasion began, as nations across the continent shatter spending records. Step 4 is energy, at 10 to 15%. Geopolitical tension restricts global supply. When conflict threatens critical shipping routes like the Strait of Hormuz, the market prices in supply shortages, and energy stocks generate massive cash flow. Step 5 is consumer staples at 10 to 15%. Demand for basic necessities remains constant. Regardless of the geopolitical context, consumers continue to purchase laundry detergent, paper towels, and over-the-counter medicine. Combining defense, energy, and consumer staples creates an active growth engine. This strategy harnesses the industrial scale and supply chain friction that global conflict produces. Step 6 is inflation protection at 5 to 10%. This step requires avoiding the traditional safe haven of standard long-term U.S. Treasury bonds. To fund a war, governments borrow massively and issue enormous amounts of new debt. This often results in inflation that destroys the value of standard bonds. Sarah used TIPS, Treasury Inflation Protected Securities, which automatically adjust their principal when the Consumer Price Index rises. The strategy hinges on one non-negotiable directive: never liquidate core broad market index funds. Wartime volatility is historically lower than the peacetime average, and these assets capture the broad stimulus of the war economy. This area chart shows the final 4-year tally. Mark sold everything to sit in cash and ended with roughly $48,000. Sarah maintained her structured portfolio and reached approximately $91,000. Sarah's $43,000 advantage was a direct result of her mechanical discipline. She maintained her automatic contributions while high-quality assets were at a discount, capturing the full recovery that Mark missed by retreating to the sidelines. The time to build this structure is during peacetime. Establishing the cash floor, the gold baseline, and the growth engine today ensures that a rational plan replaces panic the moment the next crisis begins.